Good afternoon. On behalf of the NC Chamber, I would like to welcome you to an overview of CARES Act tax relief for businesses. I am Janelle Boyd with the NC Chamber. All attendees are muted to avoid any distractions during today's presentation. If time permits, we will answer as many questions as possible at the end of the presentation. If you would like to submit a question during the meeting, please use the question and answer box. Please do not use the chat box. You may upvote the questions you most want answered by clicking on the thumbs up for that question. The questions with the most votes will be answered first. This presentation is being recorded and will be made available to you via email. Now, I would like to introduce Gary Salamito, President and CEO of the NC Chamber.
Time today to be on the call with us. Thank you, Janelle. It's my pleasure to introduce our two experts in taxation. Bill Nelson is an attorney with Smith Anderson here in Raleigh. His principal practice areas are federal and state taxation, mergers and acquisitions, and private equity transactions. Bill also serves as the chair of the NC Chamber Tax Committee. Our second expert today is Jim Nicholas, a senior vice president and chief financial officer at Marietta. Jim has extensive experience in finance, accounting, tax, and mergers and acquisitions. Very pleased to have Jim with us today also. Thank you both, Bill and Jim, for joining us today for this important conversation. With that, I'll turn it over to you, Bill.
Thank you, Gary, and good afternoon to our audience. We know that these are challenging and uncertain times for everyone, and we're very grateful to the Chamber and its great staff for taking the lead in providing guidance and insight to help the business community through this situation, and we're certainly delighted to be part of that effort. We're going to focus today on the business tax provisions of the CARES Act. I should say at the start that any discussion of the CARES Act at this point is challenging for several reasons. First, the Act is obviously very new. It was signed by the President and became law on March 27th, less than 2 weeks ago, and our understanding of it is therefore less than perfect at this point. It's also a massive piece of legislation. To give you some idea of the size, the printed version is 880 pages long and stands at about 4 inches thick and weighs almost 9 pounds. There's a lot to digest. We're narrowing the focus today, of course, just to the business tax provisions of the Act, but you should know that there are important individual tax provisions in the law as well. These are summarized in the CARES Act alert that I believe are part of the program materials. In addition to being big and new, the Act was written in haste, and some of the language in the statute reflects this. So understanding what each provision means and exactly what Congress intended is not always easy. And finally, while all of this creates an urgent need for additional guidance, there just isn't much out there yet. And so taxpayers and tax advisors, at least for a time, will just have to do the best they can. Let's go to slide 2, please. For a little background and context, the CARES Act is the third phase of Congress's response to the coronavirus pandemic. Phase 1 was a Supplemental Appropriations Act, which provided over $8 billion in additional spending on vaccine R&D. Phase 2 was the Families First Coronavirus Response Act, or FFCRA. This act included over $100 billion in new spending and imposed new employer mandates for paid sick leave and paid family leave related to the pandemic, and also allowed employers to recover the cost of those mandates through refundable payroll tax credits. In addition to this previous legislation, the IRS granted taxpayers with income tax payments, including estimated tax and self-employment tax payments, that were due on April 15th the ability to defer these payments until July 15th. The IRS also later delayed the filing date for income tax returns until July 15th. And finally, there is talk, of course, of a Phase 4 bill in Congress, which is likely to include a huge infrastructure component, as well as additional funding for emergency SBA loans that were enacted as part of the CARES Act. There may be further business tax provisions in the Phase 4 legislation as well. Slide 3, please. So let's turn now to the CARES Act itself. The topics we'll be discussing include 2 payroll tax provisions, the new employee retention credit, and a payroll tax deferral provision. We'll also be discussing several provisions of the Act that suspended or modified changes made by the 2017 Tax Cuts and Jobs Act. These include provisions relating to net operating losses, excess business losses, business interest expense deductions, the corporate alternative minimum tax credit, qualified improvement property, as well as a temporary liberalization of the corporate charitable contribution rules. The focus of all of these changes, as you can see, is to free up cash for businesses, to help businesses remain in operation and retain their workforce. The Act does this by reducing current and future tax payment obligations to the government and providing opportunities to get refunds of taxes already paid. Slide 4, please. The first provision that I want to talk about is the employee retention credit. And we're going to spend the most time on this provision because it's the one that most people seem to be most interested in at this point. And it is a brand new provision, not a modification of an existing code provision. The employee retention credit is a refundable credit equal to 50% of an employer's qualified wages, we'll define that later, paid to employees. The credit applies on a quarterly basis for each quarter in 2020, although for the first quarter, the credit applies only to wages paid after March 12th. The credit is very broadly available. It is available to any business, regardless of size, that was in operation in 2020. It's also available to tax-exempt organizations. And here it's important to note that it is available not just to 501c3 charitable organizations, but to any organization exempt under any subsection of Section 501c. So this would include, for instance, organizations like 501c6 business leagues, credit unions, and social clubs. There's also one class of entities that is not eligible for the credit, and that is state and local governments, as well as their agencies and instrumentalities. So state schools and universities, for instance, are not available for the credit, not eligible to claim the credit. There's also one very important restriction on the employee retention credit. You can't claim the credit if you have received a loan under the Paycheck Protection Program administered by the Small Business Association that was included in the CARES Act. If you claim the credit and later receive a Paycheck Protection Program loan, the credit is subject to recapture. We don't yet have guidance on how that recapture will be implemented. The PPP loan is generally probably going to be the most valuable resource for people affected by the coronavirus pandemic. But for those that do not qualify for the PPP loan program, and this would include employers with more than 500 employees, and in particular those that may have crossed that threshold by reason of the affiliation rules included in that part of the CARES Act, the employee retention credit is a good alternative.
Hey, Bill, it's Jim. If I could add to that, the payroll protection program is a richer benefit for taxpayers, and it's probably the right choice if you can get it. I just would point out that there may there may be some operational restrictions placed on a business if they get a loan from that program, depending on the size.
All right. Thanks, Jim.
So whether that would be executive compensation or share buybacks or dividends, et cetera, that kind of thing.
Mm-hmm. Okay, let's go to slide 6, please. So to qualify for the credit for any given quarter, an employer must have suffered one of two consequences as a result of the pandemic, and I'll refer to these as triggering events. The first trigger is a suspension of trade or business operations due to governmental restrictions relating to the pandemic. And the second trigger is a significant decline in gross receipts. So to flesh each of those out, a suspension of business operations must be due to an appropriate governmental authority imposing restrictions on business operations by limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to COVID-19. This is very broadly worded, but the scope is not completely clear. It clearly covers a situation where the government order applies directly to a business. So for instance, where an order requires a restaurant to close, that restaurant has clearly been shut down due to the order. But what about a business that isn't the direct target of a governmental order, but is affected by the order? For instance, if a restaurant food distributor has to shut down because its restaurant customers are shut down, is that distributor covered? We don't have a clear answer to this, but I would argue that the distributor, in my example, that his shutdown is due to the order, even though it wasn't the direct target of the order. There's clearly a causal relationship between the order and the shutdown, and that seems to be all that the statute requires. And importantly, the statute also provides that the suspension can be full or partial. The IRS has issued some guidance in the form of an FAQ saying that a partial suspension is a situation where business operations continue, but, quote, not at normal capacity. And the guidance gives an example of a partial shutdown of a restaurant that had to discontinue service in its dining room, but continues with curbside or takeout service. So in other words, a discrete segment of the business was suspended, but the rest of the business was able to carry on. But the not at normal capacity language in the statute would seem to cover a wider variety of other cases. It's not entirely clear, but it would arguably cover a general slowdown in business as well as the complete cessation of a discrete business activity. The difficulty here may be one of proof. How will an employer show that a general slowdown in its business was due to a governmental order? The statute also makes clear that for tax-exempt organizations, suspension of operations can qualify as a suspension even though those operations don't constitute a trade or business. So the second trigger for claiming the credit is a significant reduction in gross receipts. And this trigger applies to a business that suffers a more than 50% decline in gross receipts for a quarter measured against gross receipts for the same quarter of 2019. And the business will continue to be able to claim the credit in subsequent quarters until the quarter after the quarter in which gross receipts have recovered to more than 80% of gross receipts for the same calendar quarter of 2019. So let's go to slide 7 for an example of this. Assume that a taxpayer's operations are suspended during March of 2020 due to a government-imposed restriction. And during the second quarter of 2020, assume that the taxpayer resumes operations, but its receipts are down by more than half compared to the second quarter of 2019. And then in the third quarter, assume the taxpayer's revenues rise, and by the fourth quarter, they are more than 80% of revenues compared to the fourth quarter of 2019. So in this situation, the taxpayer can claim the credit for the first quarter of 2020 because of the first trigger, the suspension of operations. And the taxpayer can claim the credit for the second quarter because even though it was back in operation, it suffered a significant decline in gross receipts. So the point here is that the credit can be triggered by a shutdown in one quarter and a decline in revenues in another quarter. And the taxpayer in the example can continue to claim the credit for the third and the fourth quarters because it was only in the fourth quarter that its revenues recovered to a level that was higher than 80% of receipts for the same quarter in the previous year. To vary the facts a little bit, had the recovery in gross revenues occurred in the third quarter, that is, had they exceeded 80% of gross receipts compared to the third quarter of 2019, the taxpayer would not be able to claim the credit for the fourth quarter unless there were another suspension of business activities in that quarter. And as I read the statute, once revenues have recovered, the revenue loss trigger cannot apply again. So if the taxpayer's receipts had recovered to more than 80% in the third quarter, and in the fourth quarter they fell again, but there was no suspension of business activities, as I read the statute anyway, the credit would not be available in that quarter. So let's turn to slide 8. Once you have determined that an employer is eligible for the credit for a given quarter, the next issue is to determine what wages paid during that quarter are qualified wages. Some rules regarding qualified wages apply to all employers, and others depend on the size of the employer. Is the employer a large employer or a small employer? So starting with the generally applicable rules, for all employers, as I said before, qualified wages for the first quarter include only wages paid after March 12th. Second, all employers can include in qualified wages a pro rata share of the employer's qualified group health plan expenses. Third, for all employers, qualified wages paid to any one employee are capped at $10,000 for all quarters. This means that the credit amount, since it's 50% of qualified wages, is capped at $5,000 per employee. And if you reach that cap in one quarter for that employee, you'll not be able to get a credit for any additional wages paid to that employee in a later quarter, even if you're still in a shutdown or a state of significant revenue loss. And then finally, for all employers, you can't treat as qualified wages any wages for which you claimed a credit under the FFCRA. And so recall that the FFCRA imposed paid sick leave and paid family leave mandates on certain employers and provided a credit equal to the wages required to be paid. So if you claim the credit, if you claim the FFCRA credit for those wages, you can't claim the employee retention credit for the same wages. And since the FFCRA credit is equal to 100% of required wages, you should always claim the FFCRA credit with respect to any wages that were mandated by the FFCRA and claim the employee retention credit for other wages. And now for the rules that depend on the size of the employer. And the cutoff between small and large employers for this purpose is 100 employees. Specifically, if you had 100 or fewer full-time employees on average for 2019, you are a small employer. If you had more than 100 full-time employees on average in 2019, you're a large employer. And a small employer that qualifies for the credit for a given quarter can treat as qualified wages all wages up to the $10,000 maximum paid to all employees during any period when the business was suspended or during any quarter covered by a decline in gross receipts. Large employers, on the other hand, can only treat as qualified wages wages paid by the employer with respect to which an employee is not providing services due to triggering circumstances, i.e. either because of a shutdown or because of a significant revenue loss. And this language suggests that the employee, suggests to me anyway, that the employee does not necessarily have to be entirely idle or unpaid leave. Rather, if the employee is working on a reduced schedule, but without a reduction in pay, at least arguably some portion of the wages paid to that employee are potentially qualified wages. And although the maximum credit for wages that you can pay, that are paid to any one employee is capped at $5,000, this interpretation may enable you to increase the number of employees for which a credit may be claimed. That is, you may have a large number of employees whose services have been reduced, and a relatively smaller portion of your employees who are totally idle or on unpaid leave. I will say, though, that that interpretation is based on the language of the statute, which, again, to quote it, says that wages paid by the employer with respect to which an employee is not providing services. That, again, suggests to me that a portion of the wages you're paying to an employee who is rendering some services may be eligible for the credit. But I will note that the IRS website summarizes this rule by saying that the credit applies for large employers, applies to wages paid to employees, quote, who are not providing services. And in another place, it says who did not work, which suggests that the IRS may view the qualified wages being, for large employers, being limited to wages paid to employees who are not rendering any services at all. Anyway, this is at one point where it would be helpful to have clarification from the service. So let's go to slide 9. There are aggregation rules that apply to determine whether related employers are treated as one employer for purposes of these rules. And these aggregation rules could be complicated, but in general, they include parent-subsidiary relationships, brother-sister entity relationships, as well as entities that are treated as part of an affiliated service group for qualified plan purposes. And one more thing I'd like to note about the aggregation rules, I think they were pretty clearly intended to aggregate businesses for purposes of determining whether the aggregated businesses exceed the 100 employee threshold. But it's also possible that they can be used for purposes of applying the significant revenue loss rules. That is, if you have to aggregate with another entity, you might not just have to add the other entity's employee headcount to your own to see whether you're a large or a small employer, but you might also have to add its gross receipts to your own to see if you qualify for the credit for a given quarter due to a significant decline in gross receipts. So let's advance to slide 10 for a look at how you claim the credit. Functionally, the credit applies only against the employer's portion of the Social Security tax. That is the 6.2% tax due on wages up to the wage cap of $137,700. However, if the amount of the credit exceeds the employer's Social Security tax, the excess is refundable. And refundable amounts will be offset against all payroll tax liabilities of the employer reported on the 941 for that quarter. So that would include all employer payroll taxes, that is the employer's Medicare tax, and withheld employee income tax and withheld employee FICA taxes. And there are 3 ways to access the refund amount before the end of the quarter. An employer can first access the refund by retaining any employment taxes that it had set aside for deposit instead of depositing those set-asides. employers can also access the credit by reducing future payroll tax deposits for wages that were paid during the same quarter. And finally, if a credit balance remains after retaining amounts that have been set aside for deposit and after reducing to zero all future deposits for wages paid during the quarter, the employer can file for a refund of the remainder of the credit by filing for what's known as an advance credit using a new form that the IRS has issued. It's referred to as Form 7200. At the end of the quarter, the employer is going to have to reconcile all of this on its 941 for the quarter. And on the slide, there is an example of how this works. Assume that an employer paid $20,000 in qualified wages and therefore was entitled to a $10,000 employee retention credit. And assume the employer otherwise is required to deposit $8,000 in federal employment taxes, which would include taxes withheld from all of its employees on wage payments made during the same quarter. The employer can keep the entire $8,000 in taxes that it would otherwise have had to deposit. The employer can also reduce future deposits for wages paid during that quarter by $2,000. And if the employer doesn't anticipate that it will have an additional $2,000 in required deposits for the quarter, the employer can file the request for an advance credit for the $2,000 balance by filing the Form 7200. So let's go to slide 11 and talk about the next topic, which is the payroll tax deferral provision. This provision is also broadly available. It applies to all employers regardless of size, and it permits employers to defer payment of the employer's 6.2% share of Social Security taxes due on the first $137,700 in wages. Also, self-employed individuals can deduct half of the 12.4% Social Security tax that they pay on self-employment income. The deferral applies to any taxes that were due between March 27th and December 31 of 2020. So this will obviously provide an immediate cash flow benefit to employers. The deferral does not apply to other payroll taxes, such as the employer's share of Medicare or any withheld employee income or FICA taxes.
Bill, if you do defer, I think you probably be prohibited from deducting that expense in that year. You probably can deduct it when you pay it.
Good point. Yeah. And the deferral period, you pay half of the deferred taxes at the end of 2021. That is at the end of next year. And then the remaining half are due on 12/31/22. And employers who pay the deferred taxes by the required deferred payment dates will not be subject to any failure to deposit penalties that would otherwise have been triggered. And I have seen conflicting opinions about this in sort of the tax press, but the way I read the statute, I do not believe that the deferred payments would bear interest either. Like the employee retention credit, there's a provision that limits your ability to use this deferral if you receive benefits under the Paycheck Protection Program, but the restriction is slightly different. You'll recall that under the employee retention credit, an employer who receives a PPP loan is not entitled to the credit. The deferral provision provides that you can't claim the deferral if you've had a PPP loan forgiven. So you could take advantage of the deferral, apply for and receive a PPP loan, but if the loan is forgiven, then there'll have to be some way of unwinding the deferral. We don't know how that would be implemented. So proceeding to slide 12. We're going to go now to the income tax provisions of the CARES Act. And the first of these that I want to discuss are the changes to the net operating loss rules. And as I mentioned at the beginning, this is the first of a series of provisions in the CARES Act that modifies or suspends certain provisions of the Tax Cuts and Jobs Act. In 2017, the Tax Cuts and Jobs Act made two important changes to the NOL rules. Before the Tax Cuts and Jobs Act, an NOL was first carried back 2 years and then carried forward for 20 years, although a taxpayer could elect to waive the carryback. And in addition, there was not a limit to the amount of income that the NOL could offset in the year to which it was carried. The Tax Cuts and Jobs Act eliminated the 2-year carryback in favor of an unlimited carry-forward provision. And it also imposed a restriction on the amount of income that the NOL could offset in the year to which it was carried. Specifically, it could only offset 80% of taxable income. So the CARES Act suspends both of these rules, both of these changes for the tax years 2018, 19, and 20. So this means first that NOLs that are generated in 18, 19, or 20 may be carried back, and not carried back just 2 years, but carried back 5 years to generate refunds. It also means that NOLs carried to 2018, 19, or 20 may be used to offset 100% of taxable income in those years. These NOL provisions and how they apply to any given taxpayer can be very complicated, and I would encourage you to really study how the changes are going to apply to you in light of your particular circumstances. But for a lot of taxpayers, the ability to carry a loss back to a year when the corporate rate was 35% compared to the current 21% is going to be particularly helpful. And for taxpayers that wish to waive the carryback of a 2018 or 2019 NOL, the CARES Act provides that the waiver election can be made by the due date with extensions of the return for the first year, the first tax year ending after March 27 of this year. So for a calendar year taxpayers, that would mean April of next year. So let's go to slide 13. The CARES Act also made a couple of modifications to the NOL rules to clarify or correct changes that were made by the Tax Cuts and Jobs Act. One of these was to fix an effective date provision that applied to certain fiscal year taxpayers. The other was to clarify the ordering rules for applying NOLs for 2021 and later years. And specifically, the CARES Act provides that you will first reduce taxable income by any NOL carryovers from pre-2018 years. And then you reduce remaining taxable income by post-2017 NOL carryovers up to the restored 80% income ceiling, but calculated before any deductions under Section 199A relating to the qualified business income deduction, or Section 250 relating to foreign-derived intangible income or global intangible low-taxed income. So if we'll go to slide 14, the next topic is excess business losses. In addition to tightening the NOL rules, the Tax Cuts and Jobs Act imposed another restriction on the deductibility of business losses. Specifically, beginning in 2018, the Tax Cuts and Jobs Act placed a cap of $250,000 or $500,000 for joint filers on net business losses of non-corporate taxpayers. And this restriction sunsets at the end of 2025. Net business losses in excess of the cap can be carried forward, but carried forward as an NOL, meaning that it was subject to the 80% taxable income limitation. So what this provision does is limit the amount of business losses that non-corporate taxpayers can use to shelter other non-business income. And what the CARES Act does is suspend the application of this rule for 2018, 19, and 20. So non-corporate taxpayers can therefore use net business losses to offset an unlimited amount of non-business income during these years. But it's important to remember that these losses remain subject to other limitations under the code that may apply, such as the passive loss rules or the at-risk rules. The suspension of the excess business loss rules obviously can create additional opportunities for taxpayers to claim additional business losses on an original or amended return for 2018, 19, or 20. And then a related provision, even before the Tax Cuts and Jobs Act, farmers, other than those operating as C corporations, that receive certain government subsidies generally are not allowed to use farm losses to offset non-farm income by more than $150,000 or $300,000 for joint filers. And the CARES Act suspends this rule as well until 2026. So let's go to slide 15, the business interest expense provision. The Tax Cuts and Jobs Act imposed a limitation on the annual interest expense deduction for businesses. Business interest expense deductions were limited to the sum of business interest income plus 30% of adjusted taxable income, or ATI, plus floor plan financing interest. Business interest expense in excess of the 30% ceiling could be carried forward to future years. And there were some exceptions to the limitation. Businesses with less than $25 million in gross receipts were exempted, as were electing real property trades or businesses, electing farming businesses, and public utilities. But the net business interest expense limitation obviously had a major impact on capital-intensive businesses and any other businesses with a high degree of leverage. And here again, the approach of the CARES Act is to loosen up these Tax Cuts and Jobs Act rules. And specifically, what the CARES Act does is increase the annual limitation from 30% of adjusted taxable income to 50% for 2019 and for 2020. And in addition, for 2020, taxpayers can elect to use their 2019 adjusted taxable income for purposes of applying the 50% limitation. This recognizes that many taxpayers will see a decline in taxable income from 2019 to 2020, and using 2019 ATI to measure the ceiling on net business interest will obviously have the effect of allowing taxpayers to deduct more interest in 2020. So let's go to slide 16. The Act also includes a special rule for applying the increased 50% limit to partnerships. Partnerships will use the old 30% limit of ATI for 2019, and they won't use the 50% limitation until 2020. But for 2020, partners will be able to deduct half of the excess business interest that was allocated to them by the partnership in 2019. And then the remainder of the excess business interest allocated to them in 2019 just carries forward subject to the normal carry forward rules. And the reason we believe for the special partnership rules was that as the CARES Act was moving through Congress, the March 15th filing deadline for partnerships had already passed. And so most partnerships would have already filed their returns. And if the higher limit were made available to them in 2019, they would have been faced with having to file an amended return. And for those subject to the centralized partnership audit rules, this would have just opened up, a large degree of complexity. So the decision was just made to defer the increased limit until 2020. And one more thing I want to note before we leave the topic of net business interest and that's to mention electing real estate businesses. As I mentioned earlier, electing real estate trades or businesses are not subject to the 163J limitation on net business interest expense deductions. But if you make the election out of 163J, the price you pay is that you have to use the alternative depreciation system to depreciate your property over a longer period than would otherwise apply. And so if you use the alternative depreciation system, you're also not eligible for bonus depreciation. But because of a glitch in the Tax Cuts and Jobs Act, which we'll discuss in a moment, taxpayers with qualified improvement property were not eligible for bonus depreciation with respect to their qualified improvement property. And so some of these taxpayers reasonably concluded that making the election out of 163J was a good deal. And as we'll discuss in a moment, however, the qualified improvement property glitch in the 2017 Act has now been fixed, so that qualified improvement property is now eligible retroactively for bonus depreciation. And so these taxpayers may wish to revisit those 163J elections. The problem with that is that the code provides that those elections once made are irrevocable. So, I don't think there's any way that the IRS can fix that through guidance, but, perhaps it's something that might be taken up in a phase 4 legislation. So please advance to slide 17, the corporate AMT credit. Under the alternative minimum tax, a taxpayer is allowed a credit against regular income tax for AMT paid in previous years. And to the extent that the credit carried forward exceeded the regular tax liability, it was not refundable. You just kept rolling it forward. The Tax Cuts and Jobs Act repealed the AMT for corporations and allowed corporations with existing AMT credits to get refunds of those credits over a 4-year period from 2018 to 2021. The CARES Act accelerates the refunding of those excess credits by making them all fully refundable in 2019. And so corporate taxpayers with AMT credits can claim refunds of those on their 2019 returns. And taxpayers can even elect to make the credit fully refundable for 2018. And for these taxpayers, the Act directs the Treasury to establish procedures under which taxpayers can file a tentative refund application and provides that refunds should be granted within 90 days. So please go on to slide 18, and we'll talk about the qualified improvement property, which I mentioned a moment ago. So qualified improvement property includes improvements that a taxpayer makes to the interior portion of an existing building that is non-residential real property. And so this can include a lot of things, and the amount spent on QIP can be quite significant. The Tax Cuts and Jobs Act omitted to include QIP in the list of property that was eligible for depreciation over a 15-year recovery period. And this was widely acknowledged to be just a drafting error. But as a result of that error, it became subject to the default 39-year recovery period rule. And furthermore, it meant that the QIP was not eligible for bonus depreciation because only property with a recovery period of 20 years or less is eligible for bonus depreciation. So the CARES Act fixes this problem by clearly stating that QIP placed in service after 2017 is treated as 15-year property and is eligible for bonus depreciation. So taxpayers that placed QIP in service in 2018 or 2019 can now claim bonus depreciation on that property rather than depreciating it over 39 years. So if you placed QIP in service in 2019, you can claim bonus depreciation on an original or a superseded return for 2019. You might be able to file a Form 4466 and get a quick refund of any overpaid estimated taxes for 2019. But note that if you do that, the form appears to be due by April 15th because the instructions say that it's due by the filing deadline of the return determined without reference to extensions. If you placed QIP in service in 2018, you can amend a 2018 return and claim additional depreciation, which might generate an NOL that you will now be able to carry back to earlier years to generate refunds. Or alternatively, if additional depreciation is more valuable in 2019, you might consider looking into filing a Form 3115 with your 2019 return to treat the change in depreciation as an accounting method change and claim catch-up depreciation as a favorable 481 adjustment. So let's go now to 2019, I'm sorry, to slide 19 and mention the last item that we'll discuss today, which is the corporate charitable contribution. Under prior law, corporate charitable contributions were limited to 10% of taxable income. The CARES Act increases this limit on a temporary basis from 10% to 25% of taxable income for 2020 only, and allows contributions in excess of the 25% limit to be carried forward to the next 5 taxable years. And to qualify, the contribution must be made in 2020, and it must be made in cash. And additionally, the limit on deductions for contributions of food inventory for 2020 was increased from 15% to 25% of taxable income. And so if we'll advance to slide 20, I just want to mention very briefly before we wrap up a few things about North Carolina taxes. North Carolina is a fixed date Internal Revenue Code conformity state, which means that we don't automatically conform to changes that were made in the Internal Revenue Code. Instead, every year the legislature adopts the Internal Revenue Code as of a specific date and then decouples from any code provisions in effect on that date that it wants to opt out of. And then the code as it existed on that reference date continues to apply for purposes of determining North Carolina, the starting point for North Carolina income for individuals and corporations until the legislature updates the reference date. So the North Carolina Revenue Act currently conforms to the Internal Revenue Code as amended through January 1, 2019. That obviously does not include any of the amendments enacted by the CARES Act. In January, the General Assembly's Revenue Law Study Committee introduced or proposed a draft bill that would reset the conformity date to January 1, 2020. That obviously also would not pick up any of the CARES Act changes. We do expect that the legislature will consider conforming to some of the CARES Act changes, but budget pressure is obviously going to be extreme, and worrying about code conformity is not likely to be the first thing on their agenda. They have a lot of very pressing business to attend to. And there's some uncertainty about when the General Assembly is even going to convene. They're scheduled to come back on April 28th. But at this point, we really don't know if they will, and if they do, how long they will be in session. They might convene for a short period and then come back later in the summer. The Department of Revenue independently has delayed the filing date for income and franchise taxes until July 15th and announced that a number of penalties would be waived for failures to file and failures to pay taxes that were otherwise due before July 15th. The Department of Revenue does not have the authority to waive interest, however, but a draft bill was circulated just yesterday that would waive interest on underpayments of income and franchise tax of income and franchise taxes for the period between April 15th and July 15th. So that wraps up this portion of the presentation. Jim, do you have any final comments before we turn things back over to Janelle for Q&A?
Yes, thank you, Bill. Just one comment, echoing your point about the need to reach out to your tax advisor to get specific and tailored advice. It's very important. I will add, though, short of that, the ADPs of the world may be able to tell you what they're seeing and how they're treating things for others when it comes to the payroll-related tax changes.
Thank you, Jim. Okay, in the Q&A box, I'll list the first question. It's addressed to you, Mr. Nelson. An article written by Mr. Nelson on March 27th, 2020, named Tax Provisions in the CARES Act, mentioned under the paragraph Deferral of Employer Payroll Tax Payments, stated employers who have a CARES Act small business interruption loan forgiven are not eligible for the deferral. If an employer is waiting on approval of a PPP loan and has to make payroll tax payment on April 15th, what advice can you give as to the order of action?
I think there are going to be a lot of very tricky issues around things like that. I mean, you can obviously take advantage of the deferral even with your PPP loan pending, and you can continue to take advantage of the deferral even if you have received your PPP loan. You just lose the right to it if that loan is forgiven. As I mentioned, we don't know how the IRS is going to implement the termination of the deferral benefit when the loan is forgiven. Presumably, that would mean, the way the statute is written, if the loan is forgiven, that provision of the CARES Act, the deferral provision, just does not apply to that taxpayer. So it seems to me that what that would mean is that any deferred amounts should be paid immediately once the loan is forgiven, and presumably the taxpayer would be subject to late payment penalties with respect to those, or late deposit penalties with respect to those taxes as well. So it's a calculation, I think, of running the risk of having to pay, those penalties versus the benefit of getting the loan deferral. I mean, of getting the loan forgiven.
Okay, thank you. Next question is, how do you apply or get approval for the employer delayed payroll tax payments under the CARES Act? And then apologies if you had addressed it, but it hasn't been addressed in other webinars, so they were curious.
Yeah, no, I've not seen any procedure announced for how you do that. I think you just simply, you simply do not make those deposits during the deferral period. But I've not seen anything from the service that provides any more color on that. Jim, I don't know if you have, but I've not.
No, it looks, I would call it automatic. It looks like you don't need to do anything. It's just sort of de facto in effect. If you want to act that way, you can proceed down that path.
Okay, thank you. Next question is, the PPP loan has been impossible to get so far. Are larger companies getting all of the monies? I know it is for less than 500 employees, but that seems pretty large. Does the next stage lower the number of employees so the funds may actually get to small businesses? We have 15 employees and have gotten shut out of one bank already and waiting still for the link from another bank.
Well, I'm probably not the person to answer that question. The chamber, I would direct the questioner to the previous chamber webinar, which discussed in detail the PPP loan program. But I can only say that I understand from my partners who are heavily involved in that part of the CARES Act that this questioner is not alone. I think part of the problem is just the massive number of people that are applying for these loans, the limited resources that the banks have to apply to handle the applications and process them. So it's a very common situation. I'm sorry, I don't have a better answer to that question.
That's quite all right. I'll direct the next question towards the payroll tax deferrals. So next question is for payroll tax deferral. When would we typically file and pay these taxes? How do we account for the deferral with the government, or do we just not pay and keep track of it? Seems
Yeah,
like
I think
it's
that goes
similar
back
to the one that we just answered.
Yeah, it's pretty much just automatic.
Okay. Next question is, can the employee retention credit and the payroll tax deferral be taken simultaneously?
Yes, they quite clearly apply that is, there's not an election to choose one or the other. So you can defer any payroll tax payments during the deferral period at the same time that you seek the employee retention credit. And again, if you are under the credit program, if you're not making those deposits, I mean, you have the right not to make those deposits and access the credit in that way. And if there's an excess credit amount, you can file that Form 7200 to get a cash refund of the balance without having to wait to the end of the quarter.
Okay. And the next one. Oh, that's what payroll tax is. How will restaurants calculate forgiveness for servers getting paid tips that are now being calculated as wages?
Yes, that's sorry not to be able to answer that question. Yeah. That's directed to the calculation of payroll costs under the PPP portion of the CARES Act. Again, I would direct you to the Chamber's previous webinar on that topic.
Okay. Can a church claim the Q1 and Q2 credit due to suspension of donations since the church cannot hold services?
I think the answer to that is yes. I mean, first of all, churches, like other 501c organizations, are eligible for the credit. And churches, as long as they are subject, as they are in most places, to a government-imposed ban or restriction on large gatherings, that would qualify as the suspension trigger for purposes of the credit.
Okay. It looks like most of these are directed towards the PPP. Let me see. Will the draft bill in North Carolina actually pass the legislation for no interest on payments due April 15th in time for the April 15th deadline, or will it be retroactive?
Yeah. You know, the legislature would convene at the earliest on April the 28th, and it seems it's unlikely to pass that legislation, on the first day. So I think we're almost clearly going to miss that deadline. But if the bill passes, and of course there's no way of knowing that it will, it would be retroactive. Okay.
I think we probably have time for one more. Recurring item exception available to accrue or deduct. It says IRC 461.
I'm not sure there's enough to fail for me to answer that. I'm not quite sure what the questioner is asking.
Okay, there was Steve. Let me see if I can find him. Doesn't look like he's still on the call. It was from Stephen Cornwell, so we will skip that one. I think we're about 1 minute before the hour, so we will. Most of these questions are directed towards the PPP, but we will go through them. I'll go through them, and if there are any other tax questions, we'll get them to you at a later time, Mr. Nelson.
Okay, thank you.
Okay. So I'd like to thank you all for attending today's presentation on the CARES Act Tax Relief for Businesses. Again, my name is Janelle Boyd with the NC Chamber, and it was my pleasure serving as your moderator. We hope you found today's content valuable. As a reminder, the recorded presentation will be made available to you via email. You will receive a brief survey of the webinar via email. We would appreciate any feedback you can provide, as this will allow us to improve these sessions. Thank you. Stay safe and healthy during this time.